Despite market fears, uncertainty, and an unstable financial sector, the U.S. Federal Reserve remains committed to its aggressive monetary policy. Also on Wednesday, May 3, the Bank of Canada announced its third consecutive interbank rate hike for this year. Once again, the Fed officials decided to do something about inflation, even if that meant increasing market uncertainty and volatility.
This marks a turning point for monetary policy. After 8 interest rate hikes in a row, including some hefty increases, the central bank is cooling its jets for now. But it is keeping all options on the table, ready to increase the policy rate if needed to return inflation to the 2% target. The central bank admits that even though inflation is coming down, and this is mostly because of relief at the pumps, it is still too high. It was 5.9% in January, and the bank expects inflation to get down to about 3% by mid-year. Now, all those hikes over the past year have cooled the economy, and the housing market has reacted to this year's rapidly rising interest rate environment by pulling back. Still, this analyst expects homebuyer demand to return later this spring.
Today's video delves into the potential repercussions of higher interest rates on the economic system. While interest rate hikes are often implemented with good intentions, it's crucial to understand the potential negative impact they can have. But before moving on, don't forget to subscribe to Financial Countdown and ring the bell to be notified when new content comes out. Since March 2022, there have been 10 consecutive interest rate hikes, the longest interest rate hike series in US history. As interest rates rise, borrowing becomes more expensive for businesses and consumers alike. This, in turn, leads to reduced spending, investment, and consumption. In normal conditions, the theory of continuously raising key interest rates might work to tame inflation and cool prices. Yet, there has been nothing normal since the pandemic outbreak. Energy prices, food prices, and consumer prices skyrocketed to records, the highest record in the past half-century. On top of that, the global supply chain and oil production had declined to a critical level due to the still ongoing war between Russia and Ukraine.
And we begin with breaking news, a new look at just how much a toll these rising prices are taking on your wallet. The government just reported today that prices for gas, groceries, and other goods rose 0.9% between September and October, and that prices have risen 6.2% between October 2020 and October 2021. That's the sharpest year-over-year increase in 3 decades. This news comes one day after the president talked with the heads of major shipping companies about speeding up the movement of goods from ports to store shelves, hoping to ease the shortages blamed for those high prices. And hours before the president heads to Baltimore to make a pitch for the bipartisan infrastructure bill, which he hasn't signed yet, into law.
For the first time since the 1960s, inflation has surpassed 9% in over half the nations in the world. The challenges are big, and the risk is even greater, particularly after the second longest financial crisis in US history. After the Silicon Valley Bank failure and the First Republic Bank's weakness, investors hoped for an interest rate pause. But, as analyses show, the Federal Reserve officials had another say on the topic. And since then they have performed 2 hikes with an average of 25 basis points for each hike. So, how will they affect the financial system? For starters, the economic engine begins to slow down, and a sense of caution starts to pervade the market.
What is 25 basis points, as the smart people call it, it's 0.25%, actually do? One primary way that the Fed conducts monetary policy is, of course, by setting short-term interest rates. During times of economic malaise or downturns, right, the Federal Reserve will lower interest rates to spur more borrowing and lending. Now, that might help, but overdoing it can also lead to this, which is inflation. So in a case like this, what does the Fed do? Well, they turn to the reverse, which is raising interest rates.
A failing banking system can exacerbate the impact of interest rate hikes. If banks are facing financial instability or insolvency, they may tighten lending practices and become more cautious when providing credit. This can limit access to capital for businesses and individuals. hampering economic growth and potentially causing a credit crunch. In other words, lending will be more expensive, limited, and unavailable for the vast majority. This in turn means small business bankruptcy stores will close down, and in turn, this will raise the unemployment rate to some degree. As banks face difficulties, they may reduce lending, leading to reduced economic activity. This, in turn, can worsen the financial health of banks.
In the US, where some of the world's leading money managers are warning the collapse of another American bank could lead to a credit crunch and an economic slowdown. Constrained lending as a result of stricter banking regulation could stifle credit to the US economy at a critical time. We'll be getting an expert view on this in just a moment, but first here's my colleague Samira Hussain on the collapse of First Republic.
As of Monday, First Republic customers turning up at their bank are in fact customers of JP Morgan Chase. The signs above will soon change. First Republic had been under pressure since the collapse of Silicon Valley Bank and Signature Bank 2 months earlier. Last week, First Republic revealed depositors had withdrawn $100 billion in the space of a few months. Customers feared their money was not safe,
creating a downward spiral that can contribute to a recessionary environment. Till now, there have been a total of 3 banks that failed in 2023, and keeping interest rates higher will create a negative feedback loop. In turn, it will contribute to and add to the market turmoil. Market turmoil and low investor sentiment share a negative and complex relationship with the stock market. And one reason for this negative relationship is higher interest rates. Higher interest rates are not the only problem the global market could face. This decision simply made the job of the Federal Reserve even more complicated. The Federal Reserve may be forced to raise its interest rates further to reduce the growing stress caused by the rising cost of living. Normally, interest rates' impact on the stock market can vary in the short term versus the long term. However, in this particular case, things look a lot like the 2008 market recession, which increases the possibility of a looming long-term recession. In short, the US Federal Reserve is causing another problem that could lead to a major financial crisis. A crisis that, according to analysts, may be even bigger than the one we had in 2008. We hope everyone is prepared for the coming collapse. Your opinion is very important to us. You can leave it in the comment box below this video. Thanks for watching.